Most people aspire to be wealthy. Being wealthy is synonymous with freedom. It enables you to live the life you desire. Many people fantasize about escaping the typical rat race and forging their own path. The issue is that relatively few individuals understand how to accomplish this, and financial literacy is not taught in schools. Schools teach us how to be effective employees rather than how to care for ourselves. As the middle class continues to dwindle, now is a better time than ever to learn how the wealthy handle their money. If you want to achieve financial independence, you must first study the rules. The wealthy follow a separate set of rules than the rest of us, but you don't have to be a member of some secret group to learn those rules. All they demand is an adjustment in your thinking about money and the understanding of a few easy tactics. The first strategy is to understand your cash flow. The most critical part of financial literacy is cash flow. This refers to where your money comes from and where it goes. The bulk, if not all, of a middle-class person's income comes from their job. They work for a corporation that pays them a salary. That salary is spent first on liabilities and costs, and whatever remains at the end of the month is saved. When they get a raise in pay, their liabilities and expenses normally rise to match. This is referred to as lifestyle creep, and it affects practically everyone because we all desire to be wealthy. We have this preconceived notion of what a wealthy lifestyle entails. People buy a new house, a new car, or a new iPhone because it is the lifestyle they desire. A raise in pay allows you to relocate closer to your ideal of a wealthy lifestyle. But in fact, you are no closer to leaving the rat race. If you were to lose your employment unexpectedly, you would be further away from this goal because your obligations would have increased. This raises a point that is both interesting and potentially controversial. Any debt, whether for a house or a car, is a liability. Many people consider their home to be their most valuable asset. This is not correct. Your residence is actually a burden because it costs money every month. Simply ask anyone who was impacted by the 2008 housing meltdown if their home was an asset. Assets are items that put money in your pocket on a monthly basis. A house, on the other hand, only creates income. Selling it up to that time just takes money out of your pocket in the form of a mortgage payment. Renovations, taxes, insurance, and relying on your residence are just a few examples. The expectation of an increase in value in the future is nothing more than wishful thinking. It's not a business plan. The wealthy do not consider their homes or automobiles to be assets. They understand that if it isn't producing them income, it is a liability, which means they are ultimately responsible for it. That doesn't mean that wealthy people don't have to make payments on their homes or cars. They are simply not disheartened by the amount of debt, nature as it is. Rich people recognize that financial freedom comes from altering their cash flow rather than relying simply on a job. They aim to enhance their holdings. Passive income is generated via assets. Real estate royalties, intellectual property, and self-running businesses are all examples of assets. Anything that requires little to no manual intervention on their part. For the wealthy, cash flows straight from their assets into their liabilities, lowering their overall monthly expenses. The idea is to constantly have more income from your assets than you have in liabilities. This technique has tremendous tax advantages, which I'll discuss next. Number 2 strategy. To handle your assets, form a corporation. When you have a lot of assets, you don't want the income from those assets to flow straight into your pocket. If it works, the government will reap the benefits through taxation. The income tax was designed to tax the wealthy, but the wealthy are aware that there are tax tactics that might minimize their income and hence their tax burden. The working class, whose principal source of income is their employment, and who bears the genuine burden of taxation. The government collects the first 5 months of most people's wages each year. Yep, did you hear that correctly? Taxes are the most expensive item for the majority of people. Corporations are formed by wealthy individuals who hold assets. Instead of taxing whole revenue, corporations are taxed differently than individuals. Profits are taxed on corporations, which is an essential distinction. Profits are measured simply as revenue less operational expenses. So, if a wealthy individual has a real estate business in which they buy property for sales, rent, or lease, the mortgage payments on such properties can be deducted as an operating expense from their revenue. In fact, any business expense that can be deducted, This is how wealthy people raise their standard of living without incurring the higher tax burden associated with that lifestyle. If they utilize their car for business purposes, the car can be purchased by the corporation rather than by them as individuals. If they want to go to Hawaii, they can spend some time there having business meetings. Boom! It is now the third business expense strategy. Surround yourself with professionals. Now, the corporation tax plan has significant limitations, which is why people surround themselves with a team of advisors. They usually use tax accountants and lawyers to ensure that they are in compliance with all laws and regulations. However, the good news is that those fees are also business expenses, which means they can be deducted from revenue and avoided paying taxes. A successful business owner realizes the need of hiring employees who are brighter than them and have a deeper understanding of essential areas of the business. Many business owners have relatively little involvement in the day-to-day operations of their companies. They recruit a general manager who efficiently manages their company. Even if the business just makes a few $1,000s each month, that money is nearly entirely passive. This is not to suggest that the owners have no value. They frequently grasp a wide range of aspects of their firm, but lack in-depth understanding of all the elements to properly perform the job obligations. Most people are taught in school that they must become experts in their chosen subject. While learning your craft is essential, diving deep into a particular subject of study usually involves working for someone else rather than for yourself. Owners should be masters of all skills. They should know enough about everything to hire the right individuals and keep them accountable. Getting rich is a state of mind. It will need you to think differently than everyone else, but learning a few important tactics will allow you to move your money more successfully. This is called financial literacy. I strongly advise you to begin your education and financial literacy today. If you've made it this far, you're already way ahead of the game. If you're searching for a solid introductory reference that delves much deeper into the themes I discussed in this video, I recommend Robert Kiyosaki's book Rich Dad, Poor Dad. You have complete control over your financial future. The tools are ready, and the wealth is waiting for you. What will you do with this chance? That's all for today. Thanks for watching the video. If you enjoyed the video, make sure to subscribe to our channel Luxe Haven, and don't forget to hit the bell icon.